I'm advocating for is a one-time reset as opposed to another 10 or 15 years of pain.
What does that do to gold prices?
Oh gosh, it takes them to much, much higher levels. I mean, there've been many gold standards run over the years, and some, you don't have to have 100% backing of the currency by gold, but typically you have to have at least 40% backing. And that would imply a gold price of kind of 15, 20, 25,
Yeah.
thousand
Yeah.
dollars an ounce. I mean, numbers significantly higher than we are today. So,
Yeah.
and it could go higher. There's, it depends. I mean, probably before we do the reset, there'll be some more money printing. So all that new money printed will only make that number a higher number. So my personal target for gold, Danielle, is I think we easily hit 5,000.
An imminent reset of the entire global financial system is a view shared by many analysts, financial commentators, and several prominent investors. This belief stems from a confluence of systemic vulnerabilities, unsustainable economic trends, and structural imbalances that have been building for decades. At the heart of this sentiment is a growing realization that the post-World War II monetary order, centered first around the Bretton Woods system and later evolving into the US dollar-dominated fiat currency regime, is increasingly fragile and out of sync with the realities of a multipolar economic world. A key concern lies in the sheer scale of global debt. Both public and private debt levels have exploded since the 2008 financial crisis, fueled by ultra-low interest rates and expansive central bank policies like quantitative easing. Governments, especially in advanced economies, have accumulated unprecedented levels of sovereign debt, often financing deficits through central banks' balance sheets. This has raised fears of fiscal unsustainability, with many experts arguing that current debt levels can no longer be serviced through traditional means, namely growth and taxation, without either massive inflation or default. Larry Lepard, a prominent investment manager and sound money advocate, warns about the impending systemic shock, declaring that it will force central banks to print tens of trillions of dollars and plunge the global economy into complete chaos. Lepard says the big print, his term for the Fed's expected response to the crisis, will dwarf anything we've ever seen and send gold prices to record new highs. As we present clips from Lepard's recent discussion with Daniela Cambone, please share and like this video, subscribe to the channel, and turn on the notifications bell for more videos. We appreciate the support and hope you enjoy the video.
You think we will ramp up those printing presses?
I absolutely do. And that's really the thesis of the book. The book's title, as you know, is The Big Print. And really, we've had two big prints already. We had one in '08 and we had another in 2020. And I think another one's coming. And as the book lays out, this is just because of what I call Stein's law, that if something can't go on forever, it will end. We cannot grow debt faster than GDP forever without there eventually being either a collapse of the system or a demand for massive, growth in the money supply, which really is inflation. And the Federal Reserve's third mandate, the unwritten one, is financial stability. And when financial stability gets threatened, they run to the printer, and they will this time as well. And it's interesting, they kind of, in a way, that the administration kind of ran to the printer, or financial stability got threatened and they changed. I mean, the big dip on April 7th, when the stock market got absolutely crushed, the bond went up 80, the 10-year bond, which is the basis of the financial system, the core layer of the financial system, went up, 70 basis points very, very quickly to the mid fours. And, I think Bessent went to Trump and said, hey, you got to reverse these tariffs or put a 90-day, hold on these tariffs, or else we're going to lose the bond market. So it's, you can see the threats are growing to the bond market, to the stock market, and then by extension to the currencies, right? The dollar is through 100. Dollar started the year at 109. It's down 11% in a quarter. That's a big move. So.
Well, you're bringing up an important point that there are rumblings that the Fed already has a bailout prepared to the tune of, $2 trillion. I mean, any insights there? Is the bailout ready to go?
Yeah, I think so. I don't know, and we don't know what they'll call it. And they've got a lot of sneaky ways of doing it. They talked about the Brookings Institute had a paper where they said they're going to maybe issue swap lines to the hedge funds that are involved in the basis trade. And that's a long story, but what it basically means is that the hedge funds are buying treasury notes, and we've got to roll over $7 trillion of treasury notes this year. Hedge funds are buying them, and the Fed is more or less saying, look, if you get underwater in that trade, we'll send money to you, which is a printer. They're talking about taking away the supplementary leverage ratio for the banks, which some people have called QE infinity for the banks. And that's just an accounting rule that would allow the banks to buy bonds. I mean, the problem the U.S. has, Daniela, and you know this, is we're just in so much debt, and we've got to roll all that debt over, and, the buyers are getting scarce. And so, we're starting to look like an emerging economy. I mean, when you have, things are happening that should not happen to the world reserve currency. What are those? The stock market's going down, the bond market's going down, and our currency's going down all at once. And that hasn't happened in a long, long time, if ever, in recent memory. And the countries that have that happening, they're generally emerging market countries with a currency problem, with a debt problem and a currency problem. And so it's now happening to the world's reserve currency. And, everyone thought it couldn't because we are the dollar milkshake and the cleanest dirty shirt. But guess what? If you pursue, third world currency, policies, you get third world, currency results, right? And that's what's happening.
It feels like some sort of reset is coming. Does it feel like that to you?
It really does. And that's what needs to happen. And I think it probably will happen. But typically in the government, it's not. You have to have a real crisis before a reset happens. One positive thing. Secretary Bessent last summer gave a speech where he said he understood the problems with the world monetary system, and he felt like something akin to Bretton Woods, the last big monetary conference, was called for, and if it happened, he wanted to have a seat at the table. So I think he's very aware of the underlying issue, and I think he's prepared, and thinking about how to solve it. And there's some who would even argue that maybe they're thinking about a reset to gold. I thought it was interesting over the weekend that Trump tweeted that he who has the gold makes the rules. And then in turn, I've also noticed a lot of gold flowing from overseas back into the United States, which, one could argue maybe they're trying to refill Fort Knox. I'm of the opinion that Fort Knox was raided by Johnson to support the London gold pool in the 60s. There's gold in Fort Knox, don't get me wrong. I'm just not sure all of it's there. that I think it was raided at some point. So, yeah, it's possible that Trump and Bessent are thinking gold reset. And frankly, they should be. The solution to the problem, the book describes this. There's a chapter 22 is policy response, and talks about what we should do. There's a way out of this problem. Currency crises are not rare. They've happened all over the world for 100 years. And the positive thing, Danielle, is that when you solve them, things get better. Did a pod with a guy who grew up in Argentina in 1991. His parents were buying food every time they got paid as quickly as they could because prices were going up so fast. And of course, the currency failed and they reset to the dollar. He said a year later, Larry, everything was fine. So if we go back to sound money, and that's what the book talks about, we can repair this. This is not, if we don't get into a shooting war and we don't totally crater the economy, this is not doom and gloom. There's a solution here, but it's not, we're not going to solve it by printing more money. We've got to solve it. And by the way, going back to sound money, it'll be a one-time painful event for some.
President Trump's recent statement on Truth Social, "He who has the gold makes the rules," signals a significant shift in the geopolitical and economic narrative around gold, with potentially profound implications for its price trajectory. First and foremost, this statement aligns with growing global sentiment that gold is returning to the center of financial power dynamics. Historically, gold has always been a store of value and a symbol of monetary sovereignty. When a head of state, particularly the President of the United States, makes a comment like this publicly, it can be interpreted as an implicit acknowledgement that gold is once again being viewed as a pillar of financial legitimacy, perhaps even as a hedge against the vulnerabilities of the fiat currency system. Such a statement could signal that Trump's administration is either contemplating or already engaging in policies that elevate the role of gold in U.S. monetary or strategic planning. This could include increasing the country's gold reserves, repatriating stored gold, or preparing for a new monetary order where gold plays a more central role, possibly in the context of a gold-backed digital currency or a recalibrated Bretton Woods-type agreement. Additionally, the timing of the statement, amid mounting concerns about sovereign debt sustainability, inflation persistence, and rising geopolitical tensions, makes it even more consequential. In recent years, countries like China and Russia have been rapidly accumulating gold and reducing their exposure to U.S. Treasury bonds. Trump's comment may validate their strategy and further intensify the global trend of de-dollarization. As central banks continue diversifying their reserves away from fiat currencies into tangible assets, gold stands to benefit from institutional inflows, which are among the strongest drivers of long-term price appreciation. This is why experts like Lepard believe gold prices could easily surpass $5,000 in 2025 or at the latest, early next year. Let's get back to the video.
Mathematically, there is no way to not have a serious inflation, which is why I think betting on sound money assets right now is kind of a no-brainer bet. And that is, why is that true? It's true because there's just too much debt, and the debt needs to be devalued against the currency. The only way to devalue the debt against the currency is to write the currency up, which is effectively inflate it. So if we do this reset, we're going to have a very painful one-time high rate of inflation. Having said that, we would then, I think people would be able to tolerate it if they knew that on a go-forward basis after the reset, there would be zero inflation because we would be on a sound money standard. And so what I'm advocating for is a one-time reset as opposed to another 10 or 15 years of pain, where we just get inflated away 10%, 7%, 15%, whatever it is, right? And this reset would not be simple. I mean, it would be hard, but again, I think people can take pain if they feel like the future will be better. And a sound money future would clearly be better, in my opinion.
What does that do to gold prices?
Oh, gosh, it takes them to much, much higher levels. I mean, there have been many gold standards run over the years, and some, you don't have to have 100% backing of the currency by gold, but typically you have to have at least 40% backing. And that would imply a gold price of kind of 15, 20, 25, $1,000 an ounce. I mean, numbers significantly higher than we are today. So, and it could go higher. There's, it depends. I mean, probably before we do the reset, there'll be some more money printing. So all that new money printed will only make that number a higher number. So my personal target for gold, Danielle, is I think we easily hit 5,000. Maybe, this year, but certainly in the next several years. And then after that, I think we hit, and then I think after that we hit 10. Beyond that, it gets very fuzzy. I mean, we really don't know what the policies they're going to pursue are. It'll be there by year end at this pace. I don't think we're going to get there this year, but none of us really know, and it's a very chaotic situation. And the problem most investors have is that they're looking at the last 40 years and they didn't see any kind of chaos like this. I mean, everyone bought the dip in the stock market and everything was deflationary. And you and I and all the gold people, we've known for a long, long time these pressures have been building. I kind of compare it to like an avalanche. I mean, the snow just keeps on falling and the thing looks stable, right? That's how the economy looked. That's how the markets look. But, snow keeps falling and the cornice gets bigger and bigger. And then eventually, you get enough, another flake falls and that's it. And it triggers it and boom, the whole thing resets. And that's it feels to me like that's kind of where we are.
Central banks, particularly the Federal Reserve, the European Central Bank, and the Bank of Japan, have for years used historically low or even negative interest rates as their primary tool to stimulate economic growth. However, this has distorted capital markets, created asset bubbles in equities and real estate, and encouraged speculative behavior. At the same time, these policies have failed to produce broad-based economic prosperity, instead exacerbating wealth inequality and fueling political and social unrest. The toolkit of central banks appears increasingly impotent, with limited capacity to respond effectively to the next systemic shock. Yet, Lepard is certain that the Fed will break out the same toolkit when the fallout begins in the not-too-distant future.
My sense is Powell is a tough guy, and he's going to stand tough, and he's not going to cave into Trump. I actually think it's a little bit of a moot point, because what I think is going on is Bessent is going to force Powell's hand. I mean, Powell, if the financial system gets unstable and starts to come unglued,
right,
Powell is going to say, forget the inflation mandate. I've got to keep the ATMs running. It's an emergency. I have to do it. So Powell really needs the political cover to do what we all needs to be done. And I think Bessent lit the fuse to create, the explosion that's going to have to cause Powell to do the big print. So that's kind of how I see it going down. And all the other stuff is just kind of political posturing. When the long bond goes through 5% and the dollar, is falling into the 80s, the stock market is down 30 or 40%. I mean, in the COVID example, the stock market was down 32% and Powell panicked and printed like crazy. Stock market right now is down round numbers, just around 20%. I mean, another 20% down with an economy falling apart, no shipments from China, unemployment rising, etc. Well, they're going to change their tune. The mandate is going to become we've got to support the economy, and we've got to worry about our unemployment mandate. And yes, there's an inflation risk, but we'll have to deal with that. I can hear him saying it. He'll pivot just like he did before. So that's coming, but it's going to take a little bit more pain. And Besant is out there making sure that we administer the pain.
Yeah, it almost sounds like more printing than helicopter Ben Bernanke.
Oh, it'll have to be. So each time it gets bigger, right? We know that. I mean, Bernanke printed 2-3 trillion. It took him 3-4 years. Powell printed 5 trillion in 18 months. This one, I think this will be between 7 and 10. They'll have to do yield curve control. I mean, if they did that, entire U.S. bond market is $37 trillion. If they bought their balance sheet 6.75, they bought the entire bond market, their balance sheet would go up 4x. The point I'm trying to make, Danielle, that's most important is all of these things are inflationary. How inflationary? We don't know. But if you live in an inflationary world, the mistake the average investor is making is they're thinking the last 40 years is going to continue, and it's not. We now live in an inflationary world, and so that was the point of the book. I'm trying to tell the average citizen, get yourself ready for serious inflation because it's coming. Physical gold, physical silver, Bitcoin. In my case, I've got gold mining stocks, silver mining stocks. I run a fund that does those things. Real estate actually kind of works. I mean, the government can't print it, but they do tax it heavily, property tax. I know a lot of people my age, and I'm 67, who are, all in on stocks. And because it's the thing to do. It's worked. Since '08, it's worked. And I think that the conditions have changed, and people need to really rethink that allocation.
The writing is on the wall. The global financial system, strained under the weight of unsustainable debt, reckless monetary policy, and geopolitical realignment, is approaching a breaking point. Analysts like Larry Lepard aren't sounding the alarm for drama. They're preparing for what they believe is inevitable, a massive monetary reset that will reshape the world economy as we know it. President Trump's provocative statement, "He who has the gold makes the rules," may be more than rhetoric. It may be the first signal of a new era in which gold reclaims its central role in global finance, and the dominance of fiat currency begins to fade. Whether it's the rise of gold-backed digital currencies, a recalibrated Bretton Woods system, or simply the flight of capital into hard assets, one thing is clear: we are on the cusp of historic transformation. Those who understand the signals and prepare accordingly stand to protect and even grow their wealth. Those who ignore them may find themselves at the mercy of forces beyond their control. If you found this video insightful, hit that like button, subscribe to the channel, and turn on the notification bell so you don't miss our deep dives into the financial events shaping the future. We're committed to keeping you informed with timely insights, expert interviews, and the real stories the mainstream media often misses. Share this video with friends, family, and colleagues who need to hear this message. Thank you for watching, and we'll see you in the next one.